Canadian oil and gas has been one of the craziest investment opportunities over the last 6-12 months, with a huge shift in Canada, with the economy refocusing on natural resources and with a huge boost in investment in infrastructure to make these natural resources way more valuable in the global markets. Today, I want to talk to you about one of the best hidden opportunities that I've seen. One of these companies that could just be what you need in your portfolio to see some massive growth from this sector. Today we're talking about in-play oil, and I've got at least one analyst here who thinks that this high-yield, undervalued asset could provide a great boost to your portfolio. Welcome to Golden Arch Investing. My name is Liam. On the channel, we talk about investing in Canada, and if that interests you at all, please do like the video and subscribe to the channel. Like I said, we're going to be covering some analysis of in-play oil today, and I really think this is the first time we've really talked in detail about a microcap company. So I do want to start with a little bit of a disclaimer that I don't own this stock, and I'm not saying you need to go and buy it, but at least Matthew here, who wrote this article, sees value. And I think as an investor who mainly focuses on large caps, it's really interesting to go look at some of these small cap opportunities to see, okay, what am I missing out on? What do they offer that maybe my CNQs or my CVEs or my Tourmalines or whatever company I might own in the bigger cap space doesn't? And I think the real question is usually about valuation. In the junior mining space in Canada, we often see these small companies overvalued relative to their earnings because a lot of them are pre-earnings, right? These guys are trying to develop small assets. In-play is kind of a different story. I think there's an argument, I shouldn't say argumentative. I think there's a take that is valid that these guys are actually quite undervalued and that what they offer is a great opportunity to invest and get some real yield at quite a low cost. So let's go through the article. Summary: in-play oil is a high-yielding microcap E&P focused on low-decline cardium assets, offering 12% dividend and strong cash flow discipline. Valuation is compelling. Forward PE is about 8.5. EV to EBITDA is about 5, with the market pricing in low growth and high risk versus peers. Key upside drivers are higher oil and gas prices, efficient drilling and cardium unit 7, disciplined capital allocation. Risks include commodity price volatility, high payout ratio, but they rate in-play a speculative buy for investors bullish on oil and gas. Obviously includes most of us here, hey? Executive summary: in-play oil is a Calgary-based oil and gas exploration production company focused on light oil in West Central Alberta. Unlike larger diversified energy firms, in-play is a lean junior upstream company. It acquires and develops lower decline oil plays in the Cardium Formation, operates its own low-cost production. It has a modest 28 million share base, and it pays a rich dividend, about 11.9% yield. Key highlights: growth via accretive acquisitions. Their big move was buying the Pembina Cardium assets. They bought these from Obsidian in 2020, roughly doubled its scale and production. Those assets have showed very high returns. For example, the first 6 wells on that acquisition paid back all acquisition facility costs within 6 to 9 months under recent prices. Option 2, strong cash flow and yield. In-play's disciplined program of heavy oil weighting means high cash per barrel. Trailing 12 months revenue is about 154 million, with levered free cash flow turning positive in 24. The company now produces about 8,700 BOE per day, generating operating cash flow of 62 million. At recent oil and gas prices, management forecasts much higher cash flow in 25. Capital spending cut 25-30% via 24, boosting free cash flow. In-play's balance sheet is modestly leveraged, debt to equity at about 24%, but has ample liquidity and stable hedge lines. Compelling valuation: in-play trades at a low multiple metrics, for P is only 8.5, EV to EBITDA is 5.2, reflecting the market's wariness of junior producers. Which is true, we've avoided a lot of these companies because the market doesn't like them usually, and it takes one that's really special for the market to value it at the right rate. Yet with production mostly stable, commodity prices improving, these multiples look attractive relative to peers. Stock share prices lagged larger peers, and its high dividend yield suggests the market expects slower growth. If in-play achieves its forecasted 25 cash flows, with its continuation of cutting costs, even modest re-rating could drive significant upside. In-play is a high-yielding microcap oil E&P with proven cardium asset base. Company offers oil exposure with substantial natural gas upside via new pipelines and LNG demand. Its return hinge on commodity prices, but management's focus on free cash flow and reducing costs rather than sheer production growth aligns shareholder interests. We believe in-play is a speculative buy. Its assets are solid, trades cheaply, though risks remain if energy prices fall. So I guess that brings the question, like, if you're investing in this company, do you think oil prices are going up this year? And the smaller the company, the more that short-term difference matters. So if they really are exposed to natural gas in the way that the author claims here, we should see that work out pretty well for them. I mean, AECO prices, Canadian natural gas prices, are expected to go up significantly this year. WCS prices, Western Canadian Sedimentary Basin oil prices, are also expected to climb over the next little bit, thanks to TMX being fully operational and thanks to other projects probably coming online, or at least, being announced in the next couple of years. So I'm fairly bullish. We'll see. Company overview and background. These guys are a pretty young company, founded in 2012, headquartered in Calgary. Company's business is conventional upstream oil and gas, acquires and develops mature oil fields, gas-bearing assets in Canada, predominantly in the Pembina/Central Alberta region. Their produced commodities mix was roughly 40% crude, 43% natural gas, 17 NGLs. While primarily an oil company, its Pembina area assets do produce significant natural gas. Part of why I think it's a bullish time to buy them now, because again, that natural gas price is expected to dramatically increase. Historically, they grew by buying tired fields from larger producers, often in exchange for a carried interest or takeover lease liabilities, and by drilling new wells and proven plays. So they're not as speculative as you might expect. Flagship assets are multiple Cardium horizontals, where it's drilled dozens of high-rate wells. Notably, Q4 2020 to Q1 22 saw InPlay purchase 6,000 barrels of oil a day of Cardium production at very attractive valuations. Management then drilled this unit extensively. First 6 wells came online by mid-21, quickly paid out, followed with drilling another Cardium block in late 23, early 24, resumed activity there in fall 24. Investments have roughly doubled production per share since 2019, despite minimal share dilution. So that's pretty great. Technically, InPlay's production reserves are concentrated. Over 85% of output is from Cardium wells, so it's quite a pure play, gives the company a homogeneous asset base, reducing diversification. However, the Cardium play is a long-lived and relatively low cost with established infrastructure. InPlay also developed natural gas infrastructure to handle its gas portion. Importantly, management aims for high capital efficiency. Most of its projects pay out in under a year at current prices. Finding costs for new PDP barrels have averaged only 12-14 BOE, one of the best in its peer group. InPlay carries modest debt, about 68 million Canadian, maintains a conservative policy, hedges part of its output, and targets leverage under 1 times debt to EBITDA. The company's board and executives hold a large stake, 47% insider ownership, aligning interests with public shareholders. That's a crazy insider ownership number. InPlay has paid dividends since late 2022, currently at about 15 cents a month or 18 cents a year, 12% yield at a $6.66 share price. Despite its microcap scale, it is followed by analysts and trades thinly, about 21,000 shares of scale a day, implying a volatile but potentially undervalued stock. Very true. One of the big things we've seen with a lot of these smaller companies getting bought out has also been the idea that, hey, it's really hard for big companies to invest in these microcaps. If you're trying to move a block trade, how do you do that if you only really see 21,000 shares traded a day? And it's a $6 share. So we're talking, that's like $300,000. So if you're a several $1 billion fund and you even want a tiny stake here, you can't possibly buy it in a short period of time. Also, you can't exit, which is kind of the bigger deal. InPlay Oil has completed its $301 million acquisition of Cardium light oil assets in Alberta's Pembina area from Obsidian, funded through a mix of financing, credit facilities, share instruments. That significantly increases InPlay's production base and deal not debt, and credit capacity, with new board members from Obsidian joining InPlay. Company also issued caution about forward-looking statements, outlined potential risks related to commodity pricing, regulation, financing, and global events. Their strategic position. Their strategy is oil-weighted growth, free cash flow focus. Management emphasizes returning cash to shareholders via dividend and debt paydown, rather than aggressively reinvesting in new drilling unless returns are high. It's probably good. I think that's been the playbook for the last 5-10 years. We'll see if it continues to be. If we do see like significant expansion of infrastructure, maybe the play will shift, but I'm sure management would then be able to make that decision. Maximizing Cardium production. InPlay's core plays the Pembina Cardium. Expansion of the Cardium Unit 724 is expected to be the largest catalyst for 25-26. Company drilled 4 horizontal wells there in late 24 at a 25 to 30% lower cost than previous ones. These wells have strong initial production, lower decline, supporting flat to modest production growth in 25, even with fewer total wells drilled. Management says 70% of 2025 drilling will be in this high return area, minimizing incremental infrastructure costs. Really good time to do that. If you think about if there's ever been a time when you want to sort of keep those capital expenditure costs down, it's been right now. Natural gas upside, of course. InPlay's gas pricing outlook has improved. After a prolonged slump, Canadian gas prices rebounded sharply in late 23 and 24 due to seasonal demand, renewed U.S. gas-fired power need, and LNG projects coming online. We've talked about the LNG potential in Canada. The LNG growth of like the actual ability to export from North America is insane. It's going to double in the next 3 years. So natural gas prices across the continent are going to improve, with Canada being hit the most significantly because we've had the cheapest natural gas basically anywhere on Earth. Let's see. In plays, management expects AECO to stay well above historical lows as U.S. exports draw heavily from Canadian gas. Since gas accounts for 40% of in-place production and much of its 25 production, higher gas prices significantly boost cash flow. Capital discipline and balance sheet. Unlike juniors that drill growth at all costs, in plays in recent years prioritized free cash flow. 24, it ran a $63 million capex budget, hedged some output to ensure stability. For 25, guidance points to similar production with lower sustaining capex. In other words, in-play plans to generate significantly more free cash flow by drilling only high-efficiency wells. End of 2023, net debt was about $68 million. They expect to pay it down to around $60 by the end of 24, applying debt to EBITDA around 7.7 to 0.8 if prices hold. This is a strong focus on debt reduction, plus a $500 million credit line, suggesting they can withstand a temporary market downturn. Also promise to maintain the dividend, raising it only if it fits cash flow. Financial health. This is important when you're buying something small like this. You really need to know. So, in-place financial statements show a transitioning profile, still small profits but improving cash generation. Revenue is about 154 million, which is up from 134 million. EBITDA at 62 million. Net income at 4.9 million with an EPS of 30 cents diluted. Implies very low net margins, about 3%, but the company carries about $68 million debt against 286 million equity. For debt to equity of 23% or debt to cap at 19, interest costs are modest, 6.7 million annualized. Since rates on energy credit lines have been low, in-play has negligible cash on hand and a current ratio of 0.89, which is lacks coverage of near-term liabilities. But much of its debt is long-term. Importantly, after year-end 24, in-play expects to reduce debt to 60 million. From a cash flow perspective, in-play's operating cash flow over the trailing 12 months is 62.24 million, which is largely funded a capex of 51 million trailing 12 months. Left positive levered free cash flow after interest of about $10 million. Notably, the quarterly pattern in 24 showed OCF of 20 to 21 million in 24 and capex again 20 to 25 million per quarter. So free cash flow is roughly break even each quarter after paying dividends. With further cost savings, possibly slightly higher commodity prices, 25 should generate clear net free cash flow. Profitability metrics are currently thin but improving. Their gross margin is about 50 to 55%. EBITDA margin is about 40%, operating margin 9.6%, net margin 3.2%. So they're all modest but consistent with the company in reinvestment mode. Returns on equity are extremely low, about 1.7 trailing 12 months. Return on assets of 1.7. However, these ROEs will rise as in-play ramps production adds wells at a low cost. So basically the story here when you're talking about financials, have they been super profitable? No. Have they been kind of dragging over the last 2-3 years? Yeah, 100%. But where does that give opportunity, right? Okay, if things are turning around for them, here's where you want to be buying, because right now things don't look great for them yet. But if it does, and I expect it to, think about that. 40% of their company's natural gas prices are going to increase dramatically. That's a huge amount of potential free cash flow they could just be sitting on that they don't even know of. They're also managing to become more and more efficient over time, so they're likely to see some additional value. And the cherry on top, what is the name of the game right now in Canadian oil? It's mergers and acquisitions. And these guys are a great target for some of the companies in the space. Now, you could make an argument that you'd rather see them just sort of boost out of here, and the investors who invested at higher levels probably don't want these guys to be bought out. But at the very least, it puts, again, a floor under the danger of losing on this company. With the price the way it is and sort of the cash flows and the dividends, you're unlikely to see this thing drop. Instead, I think as oil prices improve, as Canadian natural gas prices improve, you're likely to see these guys grow considerably. So if you compare them to some of their peers, and we won't go too much because we don't talk about microcaps, so we don't know most of these peers. But again, their revenues are a little bit higher than most of them. Revenue growth is a little bit slower, right? Dividend yield is much higher. So they have some advantages. I think the debt to equity shows a clear advantage over some, but not over others. It's really kind of a mixed bag. They're solid. Amid their peers, they're pretty solid. They have the same kind of risks that you would expect from any company in the space. And as far as the outlook, it's an opportunistic longer-term hold, according to this advisor. Current share price appears to price in low oil and gas prices near zero growth, but their pipeline of high return drilling opportunities mean even under conservative assumption, cash flow could far exceed what's priced in. So if we see oil, in the 70s, gas recovers to about $3, you're going to see insane cash flows for these guys. So what do I think? Looking through all of this, reading through all of this, right? The idea at the top of this article was, okay, is this an undervalued stock with a great yield? Maybe. But I think the biggest play here is that you could see a dramatic re-rating in the shorter term. I think this stock is likely to follow what we saw with names like Birchcliff, where you see short-term positive momentum turn into serious stock price gains. If not, I think you might even see something like what happened to Meg, where you see these guys getting offered to get bought out or actually getting bought out and having a really fast short-term boost. And what is the downside? Well, you're holding a 12% dividend stock. So the dividends alone on this company are coming close to averaging what you'd get on an index fund. So are you willing to take that risk? That you hold onto something that has a sort of low, slow growth that just pays out a crazy dividend, and your upside potential is you get a crazy, 30, 40, 50% run in the short term because of higher realized natural gas and oil prices. I think there's a lot of investors out there that would be willing to hold that stock, that would be willing to be part of that story. And if you're putting it as a small part of your portfolio, I think it makes a lot of sense. So let me know what you think in the comments down below. In play, are you interested? Is it too small for you, too risky for you? Are you willing to hold something like this? Do you already hold it? Or of course, are there others in the field that you think are, similar size, better opportunity? I would love to hear from you guys in the comments. If you watched this far in the video, please do like it. If you like this kind of content, please do subscribe. And as always, I hope I see you in the next video.